Hi, I'm Harper Jones with Life with Leverage, and we coach you on the infinite banking concept and how you can become your own banker. Today, we're going to talk about how you can start life insurance contracts and practice infinite banking with your kids and start policies on them when they are younger and see the great benefits that can be offered, not only from infinite banking, but how it can accumulate capital or cash for them, for you, and for their future. There are alternatives like a 529 plan or some other savings accounts you may use to help grow cash with your family or your kids. And I'm going to show you how this really would be a better alternative than those vehicles. So let's go to my screen here. And this is one of the insurance carriers we work with called Emeritus. They're a mutual insurance company, been around since 1887. This is one of their whole life policy products. I was actually on the design team as they were designing this for purposes alongside infinite banking. That was a really cool experience talking with the actuaries and them hearing us out. That's part of why we really like Emeritus. And then this policy, specifically this product, is Emeritus Access Whole Life. And the purpose of the product is so you have earlier guarantees and access to your cash so that you can utilize it if needed. Now there's two sides here on this illustration, is what it's called. You have guaranteed value here, and you have non-guaranteed. Think of a line right here down the middle. The only difference between the two is the non-guaranteed is suggesting Emeritus is issuing a dividend each and every year, and we're reinvesting it back into the policy. They can't guarantee they're going to profit. And remember, you're entitled to the profits of the insurance company because it's a mutual insurance company. And if you want to know the difference between mutual insurance company and stock insurance company, you can watch my video I did the other week on stock versus mutual insurance companies. Now, we're going to look at the non-guaranteed side because Emeritus has issued a dividend since they've been in existence in 1887. Now, once again, since it's not guaranteed, you can't 100% bank on it. But if it was me, I'm going to look at it as it's the most likely scenario since they never skipped a year through the Great Depression or any of the other issues we've had like COVID or savings and loan crisis. Now, as we jump down to the illustration, we're going to look right here where it says cash outlay. This cash outlay is what we're putting into the policy and cash out of our pocket year over year. You can fund that monthly or annually. The next column we're going to look at is cash value. And then we're going to look at death benefit, okay? We're not going to look at this annual dividend column. And there's two ways your policy grows with guaranteed interest and then a dividend kick in at the end. Remember, this policy is geared more to guarantees. The cash outlay, we're going to fund for 10 years, $7,500. Now, there is flexibility in how you fund the $7,500, or you could fund as low as 3 or as high as 75 after the first year. But if we target funding that for 10 years, we're able to get more cash in there in the earlier years for this kid who is a newborn, age 1, as we can see over here to the left, up here at the top. So after 10 years, we have $83,000 in there. In any of these previous years, you're able to borrow against the policy and still practice infinite banking. You as the parent would own the policy. It'd be on their health, the kids, and then you could also be the beneficiary as a parent. The death benefit climbed from $628,000 to $1 million in year 10, which is awesome. And then year 11, we dropped down to just funding what's called the base premium, or $3,000, because our policy is starting to get more efficient and we got more cash in there. And then from year 11 all the way down to year 65, which in this scenario, since we started the policy when they were 0 or 1 years old, it's also they're 65 years old, we cease paying premiums, okay? Before we get down to the bottom, I want to show you that by the time they're 16 here, you have $128,000 in here. And if you're not already using it and borrowing against it, you could borrow against the policy or some of it to go buy a car. And then you could teach your kid about buying a car and finance and repaying themselves back to the policy, right? So you're becoming your own banker and teaching them about money. And also you see death benefits now 1.1 from the 628. Then let's say age 18, they go to college. You have $145,000 in here, so they could end up going to college. If they're not that smart, you could end up just borrowing from the policy because they didn't get any scholarships, and then you could repay that over the years. By the time they're 22, let's say they're out of college, they could use this to help finance a business, or if they don't go to college, let's say you had a 529 plan, it's more specific to education uh, purposes you have to use it for. And in this scenario, there's no restrictions and total freedom. So if they skip college and did a business or something else, you could use it for that. And also back to age 22, let's say you have 184K, you might have some loans on there from a car still or from college, but you could gift this to your kid. And then what happens is they take over paying the premium of $3,000 a year. And now you'll see in year 23 from 22, the cash value or cash in there goes from 195,000 from 184,000. So it's increasing $11,000 when they're only paying 3N. And this is all accumulating in a tax-free manner if handled properly. Down the road, this cash starts really compounding, and you can start using this in financing investments or using as a great savings vehicle or buying a house or a family cars or whatever else. By the time they're 66, this is when we would stop paying premiums, and you say, hey, we got a lot of cash in there. Why don't we start drawing some income from the policy? So we're going to start pocketing $75,000 a year. We won't repay any principal or interest. So the policy is going to be working for us. No more contributions needed. And we're going to start accessing $75,000 in cash each and every year from year 66 or age 66 to age 90. And let's recap the numbers. We paid in $240,000 over the life of the policy, which could be between you paying it and then the kid when they take over the policy and you gift it to them. And we were able to access or pocket 1.875 million or almost 1.9 million, which is about 8 times what we paid in, all tax free. So it's really more like 10 or 12 times, depending on your tax bracket, if you factor that in. And you still have, by age 90, $873,000 in death benefit and almost $400,000 in cash value. So the $873,000 would still pass on to the next generation. This is pretty powerful. I ran this example at someone who is a newborn. You obviously could start when the kid is any age. You also could fund a little bit heavier or a little bit lower, just depends on what your goals and objectives are. But I wanted to walk through some of the benefits and how this could be great for you, your family, and the next generation. Also have people use this on their grandkids and great grandkids for generations down in the future. So if you want to look at some numbers, run some scenarios for your kids, or just talk about infinite banking in general, you can go to my website, lifewithleverage.com, schedule a call. Love to hear from you. Or you could email me at harper@lifewithleverage.com.